Well, hello, everybody. Great for all of you to join me today for this webinar. I am your host, Ivy Han. If you're a self directed investor, chances are you're probably familiar with the three letters, and that would be E, T, and F. And that stands for exchange traded funds. Though ETFs have actually been around for many, many years now, the number of ETFs to choose from have actually significantly increased over the past decade. Now, there were more than 1,100 ETFs listed in Canada alone at the end of 2021, according to the Canadian ETF Association. And they've actually also branched out from simple broad market indices into exotic strategies and niche sectors. So, with all of this added choice and complexity, it could mean that there's probably going to be a lot of nuances for DIY investors to consider. And we're going to unpack all of that today in finer details. So, with me today is a very special guest. His name is Naseem Husain. He is the Vice President of ETFs at Mackenzie Investments. He leads the firm's ETF strategy, as well as supporting both institutional as well as the retail investor segment. And we're going to actually run through some misconceptions that investors may have about ETFs, as well as share some best practices that one can employ when it comes to these products. So, with that, I wanted to take a special moment and welcome my guest, Naseem. Naseem, it's a great pleasure to have you again and to be able to work with Mackenzie.
Thank you so much. Looking forward to the conversation, Ivy.
Yeah, absolutely. Now, before we dive into our discussion, here's actually a little trivia for all of you that are actually watching this webinar. And it's actually all about knowledge and your knowledge of ETFs. So, my trivia question is, what was the world's very first ETF and where did it first start trading? And don't worry, we're going to review the answer at the very end of our conversation. So, stay tuned for that. Now, Naseem, before we get into those savvy habits when investing in ETF, I wanted to set the stage a little bit for our audience. For those who might not be familiar with ETF as an investment, how would you describe how they generally work to a novice investor?
It's basically a tool for investors to use to get a variety of exposures, that's more diverse than just a single stock. So you can get an ETF that has exposure to a theme, to a geography, to a wide variety of baskets and securities. And I kind of aim it more for an analogy to a shopping mall where you walk in there and you can go into one store and have exposure to the financials and the experience of that store, or you can buy exposure to the whole mall, in different stores, different sectors, different exposures. And that ETF gives you that exposure to everything in that mall. Or you could pick different stores together. You could say all clothing stores and have an ETF that is just exposed to that sort of theme and that thought process. And that's kind of the general tool that the ETFs can be used for investors to be able to say, I like this theme, I like this exposure. I can now buy it with a one ticker solution.
So, when you think about ETFs, how does ETFs or how might ETFs fit into an individual investor's portfolio?
I think they could be a very powerful part of an investor's portfolio because when we're choosing our investments, we typically have ideas, or we may work in a sector, or have skills, and we might be biased to invest into what we know. And what ETFs can do is they can offer diversification. So maybe that sector goes through a bad economic turn, or something happens for that specific company. If you're invested in an ETF, you could be exposed to 100 to 1,000 or tens of thousands of different securities. So maybe one will do badly, one will do well. There's different ways to approach this. You can do it through just using your own knowledge. I want to have an index. I want to have a low cost exposure to broad market products. Or you can say, I want to have an active manager, someone who's going to pick those stocks for me, use their research teams, and try and outperform the index for better return in return for a higher fee.
Right. Now, I know it seems to be that ETFs, although it seems to be a fairly new product, they debuted it about 30 years ago. So, what are some of the, I guess, the major revolutions or evolutions we have seen in this particular product in that time?
Yeah, it's when you think of it like that, it's a overnight success story, 30 years in the making. It feels like it's only gotten popular in recent years, and it really has taken off. And that is because of, as you said, there's just simply different types of strategies that have come to market to make it easier for investors to get exposed to asset classes like fixed income, to dividends, to commodity ETF, to commodity sectors. to themes, ETFs that buy other ETFs to give more diversification exposure. There's products that employ leverage, so you can amplify the returns of a daily return of an index, and even into the more exotic sectors of popular as of late, such as cannabis and cryptocurrency. In the case of those more exotic products, investors should definitely do their due diligence, make sure they understand what they're buying and why they're buying it, and how does that help them achieve their own investment goals.
Hmm. For sure. Sounds like a lot of choices now with this particular investment. With all of those updates over the years, ETFs have certainly become more complicated, and that means there are several misconceptions that can potentially trip up investors. So let's actually clarify some of that, more common ones. The first one I have is all ETF track an index. How can investors understand whether an ETF is tracking an index or simply pursuing a strategy of its own?
Yeah, a great question. And that's the best part is there's been a lot of regulation around to protect investors when they are trying to buy a financial product. And in the case of an index product, it will actually have the word index in the name.
Hmm.
So that can make it quite simple to determine if you're buying a product that does follow an index. And on the issuer's website, on an ETF facts page that's required by the regulators to have, it'll show you what that index is, a description of that index. You can even go to that index provider's website and get even more details and background on how this index is constructed. And I would highly recommend you do that because the rules do matter. There can be different ways of constructing an index that can lead to a different return profile for your investment.
Right. Though the next myth I have, sort of along the similar lines, is, and this is actually one that I've been wondering for a little while as well, is that when you're looking at an ETF with low trading volume, we often look at trading volume for stocks, and we often look at a low trading volume ETF, which we think it might have low liquidity, which means it might be more difficult to buy and sell. Now, why is that not the case with ETF?
Well, it's pretty simple. Trading volume and liquidity are in fact correlated, but they're not the same. Volume refers to the total number of units that are changing hands at a given time. So I've decided to sell, you've decided to buy. That creates a volume effect on the exchange. It's how we note that that volume has occurred. And liquidity more refers to the ease in which you can buy and sell those securities. And when you're thinking about those highly liquid stocks on the exchange, you're seeing millions of shares trade hands. And if it's directional, you're probably participating with somebody called a market maker. And we'll get into the depths of the most important part of our ETF ecosystem is that market maker, somebody who's willing to step in at any time to buy and sell the securities that you as an investor want. And with just a dizzying array of ETFs available in the market, right now over 1,200 different products, we don't know who's going to buy and sell which product at any given time. And that's why you see products not have less trading volume. When we think about the mutual fund product, we don't see any volume because it simply happens, behind the scenes. There's no liquidity metric for that. But because ETFs are so similar to single stocks like you described, we look for that as a metric and we don't realize or we don't fully think it through that the ETF is just a wrapper that's holding underlying stocks that have that liquidity itself. So it's the underlying stocks that provide that liquidity. And in fact, it's the weakest stock within that basket. And if I had to describe it using kind of analogy, think about an ETF that was built with just Formula One race drivers. So everybody's great at driving, everybody's fast driving, and then you say let's take a team of half Formula One drivers and half downtown Toronto drivers. The skill levels can be very different, the speed in which they travel is very different, and so you can see how that would affect that performance. And it's really that ETF is going to be based on the worst performer in that kind of Toronto driving group versus the F1 drivers. And so when you take that back to the liquidity argument, when you have an ETF that's designed and it has securities with low liquidity inside it, that will determine the liquidity in which you can actually trade when you decide to buy that ETF.
Right. And I guess along the similar lines is tell me a little bit more about the market maker's role in this case. Are they sort of the behind the scene type of person controlling the liquidity in that sense?
They actually don't control anything. They respond to the market. So they have their algorithms that are watching the underlying securities and figuring out where the bid and the ask is on the entire basket of securities. And they'll use math to decide here's the weight of this particular name, say there's 5 securities in it and it's equal weighted, each one will be 20%. So if one of those stocks goes up, 20% of that ETF relative to that weight will go up. Getting a little bit technical, but every couple of seconds the quotes are going to update based on the changes of the stocks underneath. And the market maker's computers simply do that and reflect that change automatically in the quote. If they're seeing a lot of trade volume come in, that's going to send up alarms for them to basically have a human come over and take a look and say, hey, there's some activity here. Let's make sure our quotes are sharp. Let's make sure our inventory is protected and make sure that the investor can get the exposure to the assets they want at the price that reflects the underlying market. And where this really comes into to play is when you have market dislocations, you have economic events where, say rates rise or rates fall or inflation hits, you have this big announcement that might happen at, say 10 o'clock in a given day. Market makers are going to be ready to provide liquidity when you want to buy or sell into those events. And that's really more important for day traders or people looking to establish their position after an event, after a reporting period, or after some sort of news cycle.
Now, some investors, when they're getting started, they, you know, tend to confuse an ETF's what we call the net asset value, right? Also known as an NAV, with its market value. What are the key differences between the two?
Yeah, the net asset value is really an accounting term that you'll see go up on our website that will describe what is a good valuation for all the assets currently in this fund. And for equities, they'll typically be priced on the last trade on the exchange, or the closing bid, depending on if you are more conservative on your valuations. In fixed income, well, it's a much more opaque market. We don't have the same kind of screens that show you what the last trade was on a particular bond series. So issuers actually have to get that information from a third party or call around to various sources to get an average bid ask. And they'll typically report either the mid of that quote or the bid price for those fixed income. So it doesn't really reflect where an investor can buy or sell the security. So when the markets are open, that bid price that you see on your ETF and that offer price is really the best reflection on where you as an investor can buy or sell. So whenever you're looking at a NAV on a website, or if it's displayed on your trading terminal, it's a history lesson. It's from yesterday. It's a derived number. It's kind of an accounting number, but it'll give you a good idea of where this product should be. And if you're seeing that a market is looking like it's going to open up or down, or there's some positive or negative sentiment, you can say, here's what yesterday's net asset value was. The market feels negative today, so maybe the NAV should be down a percent or two. And you can sort of use that to help guide yourself in pricing. But even with that guide in mind, where the bid ask is on the market is where you can trade on any given day.
Right. That's great. Now we've clarified or cleared up some of the common misconceptions. Let's dive into some of the best practices that I guess investors can hopefully get for ETF investing. Now, the number one is to be cautious when trading ETFs within the first and last 15 minutes of the market day. Why is that?
Well, it's kind of like a race where everybody's kind of lined up at the starting line, and when the market opens at 9:30, everybody runs really fast to see where the price should be. Is something mispriced? There's a lot of excitement to decide, because basically since the market closed at 4 p.m., the market is rapidly trying to digest all that information and figure out where things should be priced. In some cases, things get priced, very high relative to where it closed yesterday, and that can cause a market halt. And that's where the regulators have said, everybody wants you to step back from the market and take a deep breath. This stock is moving very fast, and let's all make sure that it should have moved up, say 5, 10%, whatever the limit is. If you're an ETF, you're taking your prices from all the stocks, including the ones that are now halted. And if I'm a market maker, I can't buy or sell a halted stock. And when I can, which could be in minutes or hours, I need to price that risk, because you can still trade that ETF. So if you think that that halted stock is going to trade higher for whatever reason, you've read the earnings on that single stock, you can buy a related ETF that has a high weight to it. That market maker doesn't want to get run over by your investments, thought pattern, but they don't know either. So they're going to add a little bit of buffer to that their bid ask price to try and protect them from their risk. And when that market opens up, that quote will then come back to a normal level. So at these, market open and market closing times, you're exposed to this risk premium into the price. And if you want to do that, if you're using your mindset to say, I want to take advantage of this, I feel like I have a great idea, that's great, but you're paying that premium. Otherwise, if you're just trying to do this as part of your normal asset allocation, you can wait. You can wait that 15 minutes, let the markets open, let all the stocks come in, and make sure you're getting fair and accurate prices for all your ETFs. And that's simply by the virtue of waiting, 15, maybe 30 minutes in kind of the worst case to get started with your trading.
Now, the next best practice I've got on my list is to use an ETF's historical bid and ask spread rather than its trading volume, as we talked about, to gauge its liquidity. Now, Naseem, why might it be a more, I guess, accurate reading, as you might call it?
I find that when investors, including myself, when I'm looking at a stock or an ETF over time, I get a feel. Like it might be, 5 to 10 cent spread typically between the bid and the ask when I'm looking to trade. And all of a sudden, say it's a random Tuesday, and I look at it and that spread is 50 cents. It's normally smaller, but it's bigger for some reason. This gives me a clue that it's time to pull out my search engine. It's time to look at my favorite news wires and try and understand what's happening in that sector, in that space. Whatever that ETF or stock can tell me, there's probably some news going on. There could be some market disruption. There could be some economic news. There could be some, country or global event going on that's driving that spread to be wider. And it's very powerful. It's very telling because that's again showing you that people are not willing to trade that at that previous tight spread. They're more worried. They want to either make more money by the sell price being higher, or they're willing to buy it at a lower price because they're worried the stock is going to go lower. And that's where that spread can come in. It can be very telling, or it could simply be a market data glitch, and you refresh your screen, and a couple minutes later, everything is just fine. So, you know, having that feel can really help you understand what's going on in the market.
Hmm. And it seems to be that, for a lot of investors, that feel that you mentioned, it might take a while, right? But it's all about, finding the clue within the ETF, and there could be something that's affecting the ETF prices that investors should always consider, right, before they get into the actual trading. Now, the third best practice we'll mention here is to buy and sell an ETF holding international securities during hours when those international markets are open. Now, how might that help, I guess, investors to potentially get a better price for the ETF?
It's pretty simple when we're working here, for example, in Canada. We even have different time zones, so we have to even recognize that 9:30 to 4 p.m. is when our North American stock markets are open for trading. But we have products that have assets inside them that are exposed to other countries that are potentially having different trading day cycles than us. There's plenty of emerging markets that their entire stock markets are closed during our entire trading day. There's markets like Europe that are open for a part of the trading day. And when a market maker can get a real-time quote, when they can trade in Europe, in London, wherever is necessary, they can offset their risk. And whenever they can offset their risk, they pass on that to you. Wherever they can't offset their risk, they also pass that off into you in terms of wider spread. So when there's less certainty in their ability to hedge their positions, you start to pay more premium. So for example, if you're trading something that has a lot of European exposure, past 11 o'clock, things have stopped trading over there. So now it's guessing. Do you think the European market is going to open higher or lower tomorrow? Okay, well I need to price that into my quote, and I'll have different securities, in the U.S. and Canada that I can kind of use as a proxy or as a guess. This is similar to this stock in Europe, so it's probably going to trade in line with that. There's a lot of probabilities. There's a lot of guesses. If you're not trading during market hours where international securities are open, you're paying for that in terms of a little bit wider spread.
Let's move on to best practice number four, which is to be mindful of management fees associated with ETF, also known as the MERs. What's a benchmark that investors can actually use to gauge whether an ETF is charging above or below with its fees?
Yeah, price is a consideration in almost every product that we buy. If you think about the phone in your pocket, are you a value phone person? Are you using the lowest possible price product that allows you to call someone and never check your email? Or are you on the high end of the spectrum that has every feature under the sun that can control every device in your house? There's all kinds of, different solutions, and the ETF market is simply quite the same. You can buy your bargain basement ETFs that give you simple exposure to an index, for example, Canada, very easy for us to trade, and that might be 4 basis points, all the way to more sophisticated strategies that can use long, short hedging. It can use put strategies, and you can see that as high as a full percent, 100 basis points. But what we've seen here in Canada, and these numbers will go rapidly out of date as soon as I say them, but we're at about 350 billion in assets in Canada, which is a staggering number. And of those assets, 70% of them are held in products that have a fee of less than 40 basis points. And of that, 50% of that total asset amount is held in products less than 20. And so that can kind of give you a guideline for an investor. Are you using something that should be offering you something special? Are you getting something better? Are you getting some sort of strategy, risk mitigation, low volatility, access to a special sector? Then you should expect to pay a little bit more. If you're getting something that's just broad market exposures to US, to Canada, to simple markets, it should be a very low product, and that can help you because low fees over time, just simply compound. It's return that you're not losing, it's staying within your own account. If that makes sense, if you're really a big fan of different investors and you're doing their research and doing your diligence on managers, please feel free to invest in an active manager. If you're just looking for that low cost, that's why the index ETFs have so much of a percentage of the market, because they help people with that fee challenge.
Right. It seems to be the higher the fees, the I guess the higher it potentially would eat into an investor's return, right? As you mentioned. Now, the last best practice I've got is to really pay attention, and I think this is a very important one, is to pay attention to the top holdings of an ETF to avoid redundancy in your portfolio. Now, as a rule of thumb, how much can two ETFs potentially overlap in their actual holdings before it might become too, I guess, inefficient to hold them both?
It's entirely possible for you to buy an ETF that has almost 99.99% overlap. Issuers will buy the same index license, for example, to popular broad market indices. So you could have one issuer have the same index as a competitor. So if you buy one from one bank and buy one from another bank, it's the same product. It's just got a different label on it. So you can have complete overlap, even though you think that you might be buying something from a different provider. And that goes back to our earlier discussion about understanding what's under the hood. The same concept if you're just buying broad cap US, you might have 5, 10, 15, 20% exposure to tech stocks. And if you buy a tech stock ETF on top of that, you're getting way more exposure to a handful of small names than you may have ultimately realized. And then if you have another couple of thematic ones, they might have that same name in there. So it will take some diligence on your part. And again, issuers are very helpful putting that information, relatively easy to get on their website. There's some aggregating tools available on various platforms that can help you see that and compare that. But it's not going to be easy, and that's one of the challenges that do-it-yourself investors face is because there's so many different products on the market, no one can really understand exactly what you're doing. Everyone is going to be different. So it does require you to understand that here's what my major holdings are. And most times it can be very simple just looking at that top 10 holdings. You don't have to go all the way down to holding 273 and see how that overlaps. But if you're seeing things like, five, actually maybe we start as low as 3% holdings, you're going to want to see if that does appear in other ETFs at that kind of weight. And it also matters how many dollars do you have
Right.
invested in those products too. Because if you have a few dollars in that ETF that has a high weight to it, it still may not add to your overall um, your overall weight.
That's a great point. And again, Naseem, thank you so much for sharing some of the best practices with us and really clarifying a lot of the misconceptions, at least the common ones. It certainly has been valuable. Now, we're not done yet. So, what I wanted to do at this point is just take a quick moment and to be able to show our audience our WebBroker platform and especially on some of the ETF learning tools to help with their portfolio. There are hundreds of ETFs available for you to trade. So where do you start? A good place to start is from the WebBroker Research tab. By clicking on the Research tab, under Investments and ETFs, it allows you to focus your research on hundreds and thousands of ETFs by category. For example, There are ETFs that only invest in US companies or stocks that pay dividends. There are even ETFs specifically designed for people who aim to retire in 2045. When researching which ETFs to pick, the ETF screener tool and the fund comparison tool can help save you time and provide you with the information you may need to make a decision. You can find both of these in the research menu on WebBroker. The screener tool lets you create a list of ETFs that meet specific criteria that matters to you. Simply going under the tool section under research, then screeners to access this tool. If you don't know where to start, check out the list of feature screens. These are based on some of the more common criteria. And if the feature screens aren't exactly what you're looking for, you can create your own custom screen from scratch by clicking on the Create Custom Screen tab. You can also screen for items such as fund type, fund category, Morningstar ratings under ratings and risk, performance, or management expense ratio, also known as the MER from this page. To learn a little bit more about the particular criteria available, simply clicking on the item and checking out the description on the right. Creating a custom screen does take some time to make, but it can be saved and used again. Let's go back to the ETF overview page. Let's say your custom search screen found 3 international equity ETFs and each was offered by a different company. What's next? You may want to use the fund comparison tool. It's great for examining ETFs with similar objectives. This also gives you an easy to read overview of how each fund compares to one another. This can also help you gauge and determine which one might be the best fit for you. For example, if you want to minimize costs and fees, it can show you which ETF has the lowest MER, the net asset value, compared to the last price to ensure you aren't paying a much different price for the ETF than you should be. Other sections on this page that can also be helpful for comparing ETFs, including performance, which would actually show you historical returns of an ETF for a specific time period, as well as the Morningstar star ratings on a risk-adjusted basis. At the top of the ETF summary page, there is information about the fund. This includes last price, bid and ask price to gauge liquidity, 52-week range, volume, and Morningstar rating if applicable. Also on this page, you're able to see the types of assets invested under asset class breakdown, sectors that this ETF is currently investing in by percentage, geographies of the ETF holdings, as well as the top 10 holdings section showing a breakdown of the largest individual holdings by allocation. The Morningstar ratings over on the right provide historical risk-adjusted performance of this ETF and an overall rating for the fund over a specific time period. And right below, you're also able to get additional holdings information such as total net assets, dividend yield, and investment style to help better understand this ETF. Not only can these tools reduce your research time, but they can also help you make a more informed decision about which ETFs to add to your portfolio. There you have it, everybody. We're going to kick things off with our live Q&A. But first, the moment that you guys have all been waiting for, which is the answer to our trivia question. Now, in case that you have actually forgotten what our question was, the question was, what was the world's very first ETF and where did it start trading? The trivia answer is world's very first ETF was actually born in Canada. It was called the Toronto 35 Index Participation Unit, or TIPS 35, and it was launched by the Toronto Stock Exchange in 1990. And this was 3 years ahead of the first issuance in the US, which was State Street Global Advisors launch of the S&P 500 Trust ETF. So there you have it, everybody. And thank you, Naseem. Let's head over to our live Q&A to answer some of the amazing questions.